Good morning, everyone. You are watching a live daily market outlook for Wednesday, 4th of April 2012. A lot of action seen in the markets during the late hours of yesterday and as well as overnight session with the price action continuing this morning on Europe after Europe opening. Basically the widely expected the announcement of Federal Reserves yesterday on their FOMC meetings minute gave a boost to the dollar that gained across the board and against a basket of major currencies, pushing euro and sterling to their fresh lows and recovering recent losses against yen and the Swiss franc, while the commodities such as crude oil and gold depreciated further. The crude oil is currently trading at 103.50, while gold is at 16.36, well below its recent highs. The dollar index currently at 79.54 after bouncing off yesterday's levels below 79, 78, 70 zone. That were the lows of yesterday, 78.66 exactly. The Federal Reserve policymakers have backed away from the need for another round of monetary stimulus as the U.S. economy gradually improves, according to the recent data released from the U.S. Minutes of central bank meeting published yesterday showed only two of the policy-setting Federal Open Market Committee's 10 voting members saw the case for additional monetary stimulus, while the rest were against this at this point. This was a big shift from January, when several officials thought economic conditions might warrant a third round of bond purchases to boost the growth. The price change in tone hammered the U.S. stocks, bonds, and gold, while boosting the U.S. dollar. The Fed's assessment of the economy remained cautious as policymakers worried about still elevated U.S. jobless rate and potential risks to the recovery. The more hands-off tone on policy also contrasted sharply with comments last week from Fed Chairman Ben Bernanke, whose focus on high unemployment led investors to believe he might be getting ready to deliver another round of monetary stimulus known as quantitative easing. The minutes threw water on the resurrected the notion that QE3 was still very much on the table. Comments of the analysts. Another release during the night that gave additional boost to the dollar and continued its strong uptrend of yesterday's late afternoon was the data from Australia, showing that Australia posted a trade deficit at 480 billion Australian dollars in February, compared to the very positive market expectations for a surplus of 1 billion Canadian dollars, adding now fuel to expectations for Australia's central bank to cut interest rates in May. This was actually already announced 2 days ago on the rate decision of Australian Central Bank, when they kept the rates at 4.25, but hinted that a possibility of a fresh cut of the rates is on the table the soonest possible. The Australian dollar, which had been under pressure after the Reserve Bank of Australia opened the door, as I mentioned already, for the rate cut next month, fell as low as 102.63 against the US dollar, its lowest level since mid of January. This disappointing Australian trade data spurred broad selling of currencies that belong to Asia-Pacific region, pushing them to their fresh lows. The Australian dollar, as I mentioned, was hit the low at 102.63 and currently is slightly above, changing hands at around 102.80. A brief look on today's calendars. On today's calendar to see what are the what are the economic indicators that are due to be released? As mentioned, Australian trade balance already out at minus 480 billion deficit compared to 1.12 according to our forecast a billion surplus, and a negative reading of the previous month at 0.97 billion, 970 million Australian dollars. I do apologize. The next to come is series of PMIs kicking with Germany at 753 GMT. Services PMI for March forecasted unchanged for today, 51.8, still holding above the critical barrier at 50.00, but no improvement seen so far. Eurozone services PMI comes at 8 o'clock GMT, and a great improvement is seen in today's forecast at 58.7 compared to 48.7 of the previous month release, February's release, showing that possibly Eurozone's economy is picking up the pace. The UK's services PMI are due at 8:30 GMT, and the slight decrease is seen today, 53.5 compared to 53.8 of February release. At 9 o'clock GMT, Eurozone retail sales for February, 0.1% increase is seen forecasted for today compared to the January's one that grew by 0.3%. Germany's factory orders for February are due at 10 o'clock GMT. 1.2% is forecast, much better than the previous release of January that showed a negative release at minus 2.7%. U.S. Treasury Secretary Geithner is to speak at 12 o'clock GMT, while one of the key releases from U.S. is ADP non-farm employment change, one of the indicators of situation in the U.S. job market, and the best signal for the coming non-farm payrolls that are due on Friday, with slight decrease compared to the previous month release. The 209,000 new jobs are seen in March compared to 216,000 in the February. The ECB, pardon, I missed the one of the also very important ECB's rate decision is due at 11:45 GMT. No change in the policies. Expected rate to stay steady at 1%, with more clues to be given at 12:30 on ECB press conference, when the President Mario Draghi will deliver his speech and give us more hints about further steps of the European Central Bank. Later in the afternoon, 1400 GMT, US non-manufacturing PMI for March, 56.8, slight contraction compared to previous release of February at 57.3. And finally, US weekly crude oil inventories are due at 14:30 GMT. Again, building the stocks of the oil is seen for today. 2.1 million barrels is forecasted compared to a huge build of 7.1 million barrels of the crude oil, but continues in past couple of weeks. The crude stocks are building up and increasing as recent fear of possible lower demand for the oil and oil products is pushing currently the oil price lower. Now we're going to take a look at the markets and see the latest developments in the currencies and commodities. Starting with the euro on the hourly chart, we can see that the pair was firmly capped at 133.80 zone that limited the upside in the past couple of days. From the middle of last week until yesterday, the pair stayed congested under 133.80 with several attempts failing to break. The latest one was yesterday's at 133.66, and the fresh fall was triggered by initially FOMC meeting minutes release that pushed the dollar higher, and its counterparts such as the euro significantly lower. Loss of 132.80 and 132.50 strong supports and the range floor accelerated the losses through the next significant support, which is 132 zone. 131.91 is the low of 26th of March, as well as 50% retracement of the latest up move from 130.00 that peaked at 133.84. The pairs price dipped to 131.80. This was the low of this morning, with the studies in the negative territory. As we can see on the 4-hour chart, all indicators are pointing lower and still no signal of any reversal, while hourly studies are attempting to there was attempt this morning. Actually, now they are getting losing, it seems, losing traction again, and they started pointing lower. There was a brief attempt of RSI above the 30 level that will signal a break above the oversold territory for some minor correction. So far, no firm signal of any correction, despite studies being at their downside the extreme levels. However, it's not ruled out that some corrective action might be seen during the day. Initial resistance is the recent high at 132.11, along with the 132.36, where it's a 20 days exponential moving average on the hourly chart, along with the overnight's high at 132.38, with more significant barriers at 132.50, 132.80 zone that are expected to cap the upside. On the downside, that remains favored now according to the near-term studies. Next target lies at 131.47, that marks 61.8% Fibonacci retracement, and the next static support at 131.32, 22nd of March low. The situation on the daily is now losing its initial bullish tone as the study started pointing lower, and the pair briefly broke below the 55 days moving average at 132.00, as well as return to the levels below the broken bear trend line of 142.46 high. That might signal further weakness ahead, as the upside remains intact for now. The next level, as mentioned, 131.32. At this zone, there is also 90 days moving average, and the bull trend line of 126.25, low of 2012. That comes at this zone 131.17 currently. So 131.2030 zone is the next significant support for euro dollar, with the break here to confirm the top at 133.84, and basically to confirm, to signal a possible completion of the head and shoulders pattern as shown on the daily chart, with the neckline seen around 130 zone, break of which is required to confirm, and the open way for a further weakness, as the broader picture of the euro dollar shows the pair in the steady downtrend from 2011 high at 149.38. A loss of this a very significant strong support, which is also double bottom at 130 zone, and also the neckline of the daily head and shoulders pattern might trigger further weakness, and the focus 126.25 low of 2012 posted 15th of January in the short term. The cable also lost traction after upside attempts to regain the fresh yearly high posted on the 2nd of April at 60.61 failed. The latest attempt was yesterday that hit 160.43, and then steady descent started. The losses accelerated after losing support at 159.80, 159.65 zone, breaking through Fibonacci supports at 159.50 and 159.25. And extending so far to the low at 158.72. Loss of this was mentioned in our previous yesterday's analysis, that only break below 159.20, 159.00 support zone would sideline the bullish tone in favor of stronger reversal, and this is what we are seeing now with the negative structure still in play and the pair pushing lower after brief consolidation seen this morning that was capped on approach to 159.00, our initial barrier. The next targets on the downside, 158.59 low of 29 of March minus support, and then the strong one at 158.41 low of 28th of March 2012, and also very significant. This zone is 200 days moving average at 158.48, a break of which may weaken the structure of cable more significantly and open way for a further weakness and a possible test of trendline support currently at 157.67. That will confirm the top at 160.61 and the open way for further retracement of the medium-term rally from 13th of January 2012, a yearly low at 152.33. So far, the pair retraced exactly 23.6% of this move. As mentioned, 200 days moving average is our critical level at the downside, 158.50 zone, previous low also at 158.41, loss of which is to open way for further extension, break below trend line, and static support at 157.69, opens 38.2, another significant level of 38.2 Fibonacci retracement at 157.45. The dollar yen seems to be averting immediate downside risk as the latest bounce and the fresh strength of the US dollar turns away immediate risk of a stronger correction of the pair of 84.17 recent peak. So far we have seen between 23.6 and 38.2 retracement of the 76 to 84.17 rally, with the low seen at 81.54 posted yesterday ahead of current bounce. The daily studies are still in the negative territory, in the negative tone, pointing all lower. Loss of momentum sees still potential on the daily chart for a further weakness. However, on the lower time frames, the situation on the hourly chart is still positive, as all indicators broke above their midlines, and the pair broke initial barrier at 82.60, regaining so far 83.00. Our next strong resistance, it's a previous low of 19th of March. We need to see a firm break above 83.00 and the regain of next very strong barrier at 83.30-40 zone in order to confirm the near-term bottom at 81.54 and allow for fresh strength and possible test of 84 zone and recent peaks. On the downside, immediate support is 20 days moving average and the recent low at 82.56 ahead of 55 days moving average at 82.45 on the hourly chart, and the static support at 82 zone, a loss of which would definitely signal further weakness and possibly refocus 81.54. On the upside, the recent high of 83.00 posted last night is the initial barrier ahead of previously mentioned strong ones at 83.29 and 83.38, break of which is required to improve the near-term structure and avert immediate downside risk. Dollar Swiss also in recovery mode after finding good support at 90 zone. That several attempts were contained at this zone, and the fresh bounce higher through initial barriers at 90.69 and 91.00 have so far reached 91.35. Our next significant resistance high of 26th of March 2012, as well as 38.2 Fibonacci retracement of the latest down leg from 93.33 to 90.00. The structure on the 4-hour chart remains positive with studies above their midlines, but already in the overbought zone. Yet no signal of any reversal, but this might be suggesting that some corrective action might be seen preceding a fresh rally higher. On the upside, next significant target is at 91.75 zone highs of 19th and 22nd of March, also close to 50% retracement, a break of which to confirm the bottom at 90.00 and an open way for a further recovery. Any failure under 91.75 still risk further consolidation, but only loss of 91.00 would again bring a focus down towards 90.00 level. On the hourly, studies are also quite extended and already in the oversold zone, but still pointing higher, as brief consolidation was contained at 91.13, and the pair is currently heading higher again with the fresh momentum seen towards the upside. Target on the immediate target above 91.35 is, as mentioned, 91.75, our very strong, also the 50% retracement. The crude oil again lost traction after initial bounce of recent low, actually 2 days ago low at 102.06 and 102.12, where the pair attempted to post a double bottom on the 4-hour chart, resulted in a strong rally to 105.45 so far, but recent weakness of the dollar, recent strength of the dollar again pushed the oil prices significantly lower. 103.50 currently trading with the loss of initial support at 104.30 and 104 zone, now risking a return down towards 102 zone. That are the recent bottoms. The studies on the 4-hour chart are pointing higher, but MACD is still below its midline, and the RSI is still below its moving average, 7 days moving average. That is keeping the downside in focus. Some momentum has been regained, but the price action is still skewed towards the downside. On the hourly chart, situation is showing more negative outlook, as 20 days exponential moving average broke below 55 days one, and capping the current price action at 104 zone. That is our initial barrier. I would say only break above these levels and regain of 105 level would avert immediate downside risk and retest of 102 zone, with lift above 105.45 2 days ago high to open way for a more significant recovery. Daily studies are now losing pace as indicators are below their center lines, as the upside remains capped at 110.50, 109 and 90 zone, with the more narrow range ceiling at 108.68 limiting the upside. Loss of the near-term range floor at 104.34 keeps the focus on the downside, as the price broke again, is attempting below 55 days moving average, with the 90 days moving average currently offering good support, and the break of this level would signal more significant losses, possibly towards next strong support at $100 per barrel as psychological support, loss of which to open way for the 95.50 and the 95.50.60, where is also 200 days moving average. Daily Ichimoku studies on gold show that the gold's price action again is a negative mode, as the price broke below the daily Ichimoku cloud and approaches next support and previous low at 16.28, keeping the tone negative. On the daily chart, break of a main bull trend line drawn of 15.22 low, and failure to regain significant barriers at 16.90, where is Fibonacci 38.2, 200 days moving average, and the 1697 high of 27th of March keeps the downside, keeps the upside now well protected, as the pair is heading, as the price of gold is heading south and approaching next significant support at 1628. Loss of this level would open way for the further retracement of the latest rally from 1522 end of December 2012 bottom that peaked at 1790 on 29th of February 2012. The Fibonacci levels to watch at this point as the price hit nearly 61.8% retracement, and the loss of this level would definitely confirm the negative structure of recent top at 1790 and open way towards 1600 zone. That is our next significant support. On the lower time frames, situation on 4-hour chart remains negative with the price now entering oversold zone, yet no any signal of any bounce higher on the correction, as well as hourly studies, despite being in extremely extended levels, still pointing lower, keeping the downside favored with the likely test of 1628, our next support and target seen in the short term. This was all for today's live daily market outlook. Have a nice day.